Welcome back, everybody. This is your favorite investment strategist, Larry, and today we have a lot to cover. Not only are we talking about investment strategy, we're also covering mindset training in order to help you weather this brutal sell-off that's going in the market right now. Today, I'm going to discuss when I believe this painful sell-off is going to end, what signals, what macroeconomic data points I am looking at to understand when a recovery may take place. I'll talk about what I believe is going to be the path of interest rates going forward, starting in March and then beyond. I'm going to give an analysis of the latest Fed minutes, walk through what their members are thinking, and that's going to be particularly insightful for you as you know what each committee member is thinking in terms of their views on rates. I'll walk through my strategy on my plan for the next 3 months when it comes to this market. And then towards the end of the video, which you definitely want to watch, is a special note on diversification with alternative investments to find uncorrelated assets to equities that can battle high inflation. And that's going to be from our sponsor today, Masterworks. So with that said, let's get into it. Now, I know that in this market sell-off, it feels that it is you against the rest of the world. And I want to offer some psychological mindset training. Some key reminders is this. Yes, this sell-off is very painful, and I am right there with you. But remember that even the best investors who are positioned long are losing money right now. That includes major institutional investors, that includes hedge funds, and even Warren Buffett. There is essentially no place to hide except from commodities that are benefiting from this crisis, like oil, and stores of value like gold and art, which we will discuss later today, that is immune from this sell-off. So I want you to think about the retirees who are heavily exposed in the market. And at least you have time to recover, because most viewers of my channel are between the ages of 25 and 44. So unless you are retiring next year, you still have plenty of time to ride this market out long term. Now let's talk about the latest in the market. Here are some items that you already know, but that I do need to cover. The S&P 500 is in correction territory. It's under both the 50 and 200 moving day average. The Nasdaq is essentially in bear market territory. The Dow has corrected, and the Chinese Internet KWEB ETF got rejected from its 50-day moving average. Now, in terms of pockets of the market, value stocks are down. Cathie Wood's ARK stocks are down, FANG is discarded, and Bitcoin is not serving as any safe haven. Now, given the broad-based sell-off, is capitulation coming soon? And there are several macro and sentiment indicators that tell us about the market's underlying health, which I'm going to walk you through now. The first is the VIX index, and the VIX index allows us to understand the volatility of the S&P 500 in the foreseeable future. I've got two time frames here. The first is the VIX over an 18-month period. The other is the VIX over a multiple year period. And in both charts, what do we notice? It's that the VIX over a longer period of time does stay structurally under 30. Now today, the VIX is above that important psychological threshold, but longer term, it's incredibly likely that the VIX will retrace under 30, and that means that at this particular moment in time, fear is starting to rise at a level that is unsustainable, and in the coming weeks and months, that fear will fade and the markets will recover. Now, another important macro indicator that I'm looking at is the high yield market. The high yield market gives us an understanding of the stress that's happening in the credit markets. So as you can see, higher credit spreads, the higher this chart goes, it indicates that the corporate default risk is increasing. Now, historically, the high yield credit spreads are still relatively low. But if we zoom in, we can see that the high yield credit spreads are starting to break above that 50 and 200-day moving average. So that is definitely something to consider. But as long as we stay range bound where credit spreads are relatively low, I would say the health of the economy is still intact. So for now, do not panic unless we see credit spreads significantly higher from here, in which case I'll do an update in a future video. So now the next economic indicator that I'm looking at is copper. And the reason I'm looking at copper and understanding its recent price action is that copper prices indicate industrial demand, and it's a macro indicator for global growth and production. Now, given that copper is not necessarily following the equity market's decline and instead consolidating, it gives me data points that global growth for now is not necessarily impacted right away by the Russia-Ukraine escalation. That's something I'm going to continue to monitor. And then the final macro indicator that I'm looking at, among others, is the 10-year yield, because it's a proxy for inflation, economic growth, and it's also used as a discount rate in Wall Street forecasting models. A lot of retail investors think that yields are high right now. That couldn't be further from the truth. In fact, the 10-year yield is still low from a historical perspective. And when the discount rate is approximately 2%, it's very likely that the S&P 500 and the highest quality companies in the stock market can continue to rise from here, because a 2% discount rate is not a deal breaker for most high quality stocks. So as long as the 10-year yield is not rising significantly or falling significantly, instead if it consolidates into a nice healthy range between 1.7 and even 2.1%, it's likely that the market will find this 10-year yield level to be comforting for their future discounting models. Now, amidst the chaos, there is a silver lining that is emerging, and I want to bring this to your attention. In the latest January Fed minutes, it is very clear that the Fed is paying attention to the Russia-Ukraine crisis. They comment on the S&P 500 directly. They comment on the VIX. They also comment on credit spreads. So if you thought that the Fed is not paying attention to Russia and Ukraine, you are mistaken. They are looking at this crisis, and they are potentially going to adjust their policy in the future based on how events turn out. Now, here are some of the Fed minutes from January in terms of summary points. The Fed is ready to raise rates starting in March. And they indicated that rate hikes would be data dependent and that significant levels of runoff in the balance sheet could be warranted. And they're most likely looking at the third quarter in order to start significant acceleration. Now, the Fed minutes have since impacted long-term yields, real yields, and also mortgage-backed security spreads. But one item that people often forget is that the Fed continues to say that they are prepared to adjust the details based on economic developments. And since the Russia-Ukraine crisis has escalated, it's possible that the balance sheet runoff, even if it happens later this year, is going to happen at a moderately slower pace than previously projected. In addition, the hawkish landscape where investment banks have been calling for 8 rate hikes, 7 rate hikes, that could potentially be tamed down as the geopolitics are monitored across the world. So the Fed is indeed monitoring the details based on economic developments. So know that Jay Powell and his team is watching the situation closely. Now, some macro indicators that I want to continue to bring your attention towards is the producer price index to help you understand the nature of inflation and where it's going in the foreseeable future. The producer price index, which is short for PPI, is a family of indexes that measures the average change over time in the selling prices received by domestic producers of goods and services. Now, this is different from CPI, but it's an indicator of where inflation is likely to go in the foreseeable future. And in the latest month, PPI was pretty close to that 10% year over year basis. Now, here's what you want to pay attention to. Even though PPI was relatively elevated in the previous month, we can see that the momentum for PPI's growth is starting to slow down. They're starting to appear with local tops, and that's good news for inflation slowing down in the future. And if that trend continues, it's possible that the future path for inflation, it could stay structurally elevated, and it's not going to come down right away, but it's possible that that inflation CPI growth slows down, and that would also allow the Fed to walk back on some of its recent hawkish commentary. Now, the wild card, of course, is a much more severe full-scale escalation in the Russia-Ukraine crisis, given that Russia produces 10% of global oil usage, and much of that oil is shipped through Ukrainian pipelines. Oil at $100 per barrel would be a serious threat to the inflation situation. That is something that I am closely watching. Now, how else might in energy field inflation impact the economy? Well, several sectors are pretty clear to be impacted. Trucking firms, airlines, industrials, companies that make plastics, coatings, and other materials. That's going to make the input costs higher, and that could cause CPI temporarily to continue on its upward trend. Now, I want to take a moment to talk about what the Fed is looking at in their staff review for their monetary policy. According to the Fed's model, in terms of what they look at a range of factors. Nobody really knows exactly the precise metrics they look at, but after analyzing the Fed minutes, I have paid attention to the phrases, the metrics that they mention the most, and that's included on this slide here. So these are metrics that the Fed focuses on in going from US real GDP, labor market conditions, all the way down to consumer confidence. Now, whether each metric is weighed more or less, we will never truly know, but this is at least a very powerful list to help you understand what the Fed does look at in terms of their decision making, in addition to just unemployment, in addition to just the CPI and core PCE inflation. Now, why I bring this up is this. In this list, I want to take a moment to talk about some of the variables that have changed over to the downside that will lower the prospect for hawkish rate hikes more than expected later this year. We can see that the US yield curve has flattened out significantly. And that means that US GDP growth, which is one of the major factors that the Fed looks at, is likely to moderate substantially. So this blue line curve here is the current yield curve. And we can see that compared to the yield curves from just a couple months ago, it has flattened out significantly, indicating that US GDP growth is likely to moderate substantially from here. Now, given that US unemployment is very sensitive to US GDP, it's likely to increase if corporations start feeling uneasy about their cost structure. And the first thing that corporations are going to do is lay off employees in order to protect profitability and EPS. So this unemployment rate that is currently at historical lows, there is a very significant chance that that unemployment rate could rise substantially if there is greater inflation than expected, and companies will move to protect their cost structure from eating into their profit margins too deeply. Now, I'm also paying attention to the consumer confidence that is falling in the US due to high inflation, and the fact that a lot of consumers are indicating that they don't expect to have the same income growth that they experienced in the past 18 months. According to the University of Michigan, consumer confidence is down significantly year over year, and over a longer period of time, we can see that consumer confidence is falling from the last several months substantially. The Fed is paying attention to this, and given that 70% of US GDP is tied to consumer consumption, and consumer consumption is falling, the Fed is likely to not be as hawkish as the narratives say. So right now, even though Fed funds rates are at historical lows, the Fed is trying to tighten monetary policy in a perfect storm. And given that the real estate sector is something that is a big part of the US economy, and mortgage rates are now rising from its lows, making home affordability and new homeowners difficult to purchase homes, that's also likely to weigh on the ability of the Fed to raise rates too high as well. Now, I want to talk about the people who make decisions at the Fed. This is going to be particularly important to know because it's not just Jerome Powell who makes all the decisions. In fact, it's a group of Fed committee members who shape everything from the future of rate policy to the balance sheet runoff and how the Fed is likely to respond to geopolitical events. And so here we have the 2022 committee members and several alternative members who are privileged to be able to vote on Fed policy. And what I have done over the last several weeks is put together a table of each Fed committee member, each Fed alternative member, and according to publicly available information, discuss and indicate what are their views ahead of March. And we can see from this table that I've created that most Fed committee members are against a 50 basis point hike. In other words, a 50 basis point hike is highly unlikely to happen in the March meeting. And I will be following each of these Fed committee members and their views on rate path policy going forward. I will be including that information for my Inner Circle Patreon members so that they understand everything they need to know about the Fed. Now, we have a lot of major investment banks calling for 6 or 7 rate hikes in 2022, but respectfully speaking, I don't believe that the Fed has the ability to raise more than 4 times or 5 times this year, given the current backdrop. We can see that the latest geopolitical turmoil has already attracted Fed officials to come out and speak about future rate hike policy. And we can see that here on the homepage. Fed's Barkin says, time will tell if Ukraine changes rate outlook. The Fed is dynamic, the Fed is data dependent, and yes, inflation is important, but what's even more important is to protect financial stability in the market. That is one of their mandates. So my strategy for the next 3 months, well, I am a net buyer in this environment, and I will continue to be in the coming weeks amid the ongoing market dislocation. I do believe that there are deep value opportunities out there in the market. I believe that selling today is potentially a mistake if you at least have a 12-month time frame. I plan to further diversify my names and increase the number of holdings to reduce concentration risk. I plan to increase my exposure to Chinese internet once there's a consolidation on the thesis that China's continued regulation on companies will happen in the backdrop of potential monetary easing. And what I'm doing for my Inner Circle members on Patreon during this critical time is this: providing a clear plan on how to enter a position during this crisis while minimizing downside, identifying what areas have the highest rebound opportunity with the least amount of risk, formulating strategy for both beginners and advanced investors based on their range of experiences, and help them identify what themes to focus on as a rebound starts to take shape and hold in the upcoming weeks and months. Now I want to talk about alternative investments for diversification for uncorrelated asset exposure and a hedge against inflation. And this is brought to you by Masterworks, today's sponsor of the video. And I want to take a moment to introduce you to Masterworks and what they do. They have emerged as the only platform that takes on art collectors and allows retail investors to access art investments on a secondary tradable market. Retail investors can now get exposure to blue chip art from Banksy, Monet, Basquiat, and other iconic artists at a fraction of the price. It's a platform to research the secondary art market, skip the wait list, and sign up for a free account using my link below. Now, here is a very interesting observation. Contemporary art prices have outpaced the S&P 500 total return by 164% between 1995 and 2021. And we can see that during periods of high inflation, this asset class performs particularly well and is particularly durable. Now, in the art market compared to the stock market, here's how it works. When it comes to the stock market, we pick certain stocks that we like to analyze, certain companies that we like to analyze, such as Facebook, Google, Amazon, Apple. Well, in the art market, it's about certain specific paintings, certain specific art collections. And here's an example. This is an example of a particular piece of contemporary art that has done very well compared to the S&P 500. This is the Mona Lisa, and over the last several years, between October 2019 and October 2020, this specific piece of art did outperform the S&P 500 by a significant margin. Perhaps one of the more interesting parts of this asset class is that it allows investors to diversify away from equities. You can see that this is a correlation table where any value that's closer to 1 indicates very strong correlation. Any value that's closer to 0 indicates that the asset class is not correlated to the stock market at all. And that's something that's important to note. Now, this is what the homepage of Masterworks looks like. And like I said earlier, they have a secondary trading platform for specific art collections. We can see that these are several blue chip pieces of art that have been securitized and are now trading on the secondary market. And institutional research is provided inside Masterworks. That's why I signed up for an account. I get to read about certain methodologies for valuing art. I also get to read about why the global art market is so durable against such a high inflationary period. So I would say that Masterworks is a very strong research platform. It helps you understand a different asset class, and you can use this to understand investor sentiment in alternative investments. I only advocate for companies that are proven, well-known, and reputable, and I believe that Masterworks is one of those companies. Sign up for a free account using my link below. Normally, there is a wait list when it comes to Masterworks, but if you use my link below, there is no wait. You can access their research, access their platform, access their institutional coverage right away. The link is below, and it's absolutely free. Now, the conclusion from everything that I've said today is this: stay calm, stay diversified. You cannot make good decisions when you lose your nerve. And if you want guidance or you want a mentor to help guide you through this dangerous environment, let me help you. What's it worth to you if you can enhance your mindset or avoid the biggest pitfalls? My investment community hosted on Patreon can help you. And if you are a financial advisor and a wealth manager, remind your clients that market corrections are normal in the course of market cycles. And this is a period of opportunity for you to grow your firm if you have the right marketing in place. If you are in a position to try to grow your financial advising business, let's have a Zoom coffee chat to see if powerful marketing growth strategies can help you grow your AUM and your legacy, can help you stand out in a crowded market. And finally, if you wanted to understand why I plan to increase my Chinese internet exposure at the right time later this year, and why I think US inflation will go down later this year, then watch this video to remind yourselves why we need to stay patient and stay long term. And with that said, my friends, I will see you in my next video.